can I get some context on how bad this actually was? I saw this chart of the VIX, right? And like you see these lines going up on the VIX in 2008, it goes crazy, and then like COVID 2020, and then this event on Sunday and into Monday, and it looks spiky. And of course, like 2008 was world changing, and as was COVID. And this had a similar kind of like effect on the market. And indeed, I haven't seen a down day on crypto on a weekend of like 20% plus in quite a long time. And crypto kind of reverberates some of this as well. But like, how bad was this? And what's the likelihood that we get some aftershocks, after booms, that this continues?
I mean, it was pretty bad. I think you kind of highlighted one of the best measures for it, which is the VIX, the spot index, and it hit 60. And you know, again, it's not clear why the VIX hit that level. There's many reasons it spikes. I mean, it's basically the expected volatility in markets, and it did soar. Is it because the carry trade was already short vol, so that's why they had to cover, and that's why it spiked? Or is it the longs were trapped over the last few days, especially over the weekend, and one way to protect is to go is through the VIX, is through trading volatility? Or is it just the market was so uncertain that that's what happened? Because that's what happens in panics. In fact, the skewness of the puts versus calls actually went to minus 25. And again, that is a pretty rare reading. It happens usually near the end of a panic. So I think there was definitely a lot of panic, a lot of margin calls, as you can imagine. So I think margin clerks were really busy yesterday, and I think a lot of that dust is settling today. But it does sound like a lot of it was retail liquidations. I think high net worth and institutions were actually buying yesterday.
Okay. Do you think there's anything to maybe uncover at some point in time? Do you think any like major funds got sort of wiped out? I mean, we were watching this in crypto, and Jump Crypto was just sell 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 on a lot of their crypto assets. That's not definitive proof of what's going on, but like obviously when this sort of cascading high volatility days happen in crypto to the downside, people get liquidated, and it can get pretty ugly out there. Do you think some of that will we'll see evidence for that in the days and weeks to come?
Yeah, I mean, I wouldn't be surprised. Yeah, the jump, which happened over the weekend, was really stood out. And as you know, short volatility was a crowded trade. So anyone being caught short volatility on a spike to 60, I mean, that is deadly. Last year, on a smaller spike in volatility, especially across rates, had already triggered the failure of a very large multi-billion-dollar hedge fund in the U.S. And I don't really want to name that fund, but viewers can sort of look back. And so I wouldn't be surprised if there's a couple of failures, and it'll be revealed in coming days.
Okay, well, maybe there's a binary here. It's either over, that was sort of a Sunday blip, and then we sort of resume the bull market that we've been in, or it's not over, and there are worse things to come, and like more dips and more volatility, etc. What's maybe the case for each, and where do you fall on that argument?
Uh, I mean, we're in the camp that this was a growth scare. And, if the trigger was either the jobs report Friday or even this carry trade unwind, those are temporary effects anyways for markets. Um, to be concerned, it's a larger effect. One has to believe that a recession is already starting, so that the Fed can't act to contain the ripple effects, or that financial conditions tightened in a way that require more intervention, and that essentially dilutes the ability for stocks to recover. And as you know, yesterday, and I think a lot of people talked about it, the carnage was primarily in the equity markets. Credit was actually really well behaved, whether you looked at triple C or high yield or spreads or bond volatility. There's a VIX for the for long bonds, VXTLT. All of those were relatively behaved. So this really did look a lot like an equity panic. And there is a rule of thumb that we used to use at JP Morgan, which is that, bonds lead stocks. So when stocks diverge like this and there's panic, it shows you people were trying to get liquidity. They weren't necessarily responding to something had changed. And so if the selling frenzy is over, the recovery should be pretty sharp for risk assets. Knowing, of course, that we're in August.
Right, exactly. So let's say it was a growth scare. Then what's kind of your base case assumption? Does it take a while to heal from this? Do we sort of resume the same trajectory that we've been on? Do things change a little bit?
Well, there's kind of a scarcity or paucity of labor-related data in the next month because you don't get another real jobs report until August, first week of August. Sorry, first week of September for the August jobs report. So that's a month away. But as you know, yesterday, the ISM services had an employment component, and that actually showed a recovery. And on Friday, a lot of economists, including our own team, pointed out that there were so many things that made it look like Hurricane Beryl probably affected the jobs report for July. Texas is vulnerable to heat already because when it's hot, you have to slow down a lot of activity. And in Texas, jobless claims rose 20,000 in the month. And there was almost a record number of people either employed and not working due to heat, or turned to part-time because of weather for both cases. And it was like 1 million in one category and 400,000 other, and both were like 6 sigma changes for that reported category in the household survey. So I don't know. I mean, the only thing is it's incongruent, because jobless claims aren't really consistent with a huge downturn in the labor market. And a lot of it is Texas, the jump in claims, because ex-Texas jobless claims have actually for the last 4 weeks been pretty flat. And 1 million people lost power in Texas for 2 weeks. So you could see the knock-on effects on the economy from that. So I would say I think it's a growth scare.
Okay, so you think it's a growth scare, and your eyes are really on this indicator of the next jobs report that happens in September, and this should tell us whether we are creeping closer to, like using the R word, recession, or whether we've been in one, or whether we're like we resume the growth trajectory. And like, let's say jobs
And I
numbers
want to make
coming
something
good.
clear. Interestingly, so if you look at the SOM rule,
Yeah.
which is that 50 basis point rise in unemployment rate. Since here, I'm going to pull it up here. Do you know that since 1949, that rule's been triggered 12 times? Okay. And 10 of the 12 times, you are already 1 quarter or 2 quarters into a recession. 2 times a recession was delayed. One was 1959, and the second time is it was triggered in July 2003. And the next recession wasn't until 2007. So the SOM rule, the reason, and Claudia Somm herself has disavowed it actually publicly in many appearances in the last 4 days, is that you'd already be in a recession. She made this rule because she wanted a simplified way to be ahead of the NBER. And she's basically saying it's not working because COVID kind of screwed up a lot of the metrics. So unless we're already in a recession, it's a bad signal. And actually, some weird math, but if you look at forward stock returns from the time the SOM rules triggered, since the Greenspan era, the 3-month gain is 8% for the S&P. So you'd already be like in a recession, like if it's triggered. So it's actually been a terrible tactical timing tool for stocks.
Okay, so let's say we're not in a recession, jobs numbers come in like reasonably strong in September, then what happens?
Well, the Fed starts cutting, but The Fed, I think, again, sorry, I'm speaking sort of propositionally because I don't know the Fed. Nobody knows what the Fed's going to do. So I think if we're talking about September, I'm just sort of being theoretical.
Sure.
But I think that they've committed to cutting, and the labor market has softened. It's just that it's not recessionary, so they would be compelled to take action, and so it's either 25 or 50. But one variation now of the Fed's reaction function is, as you know, they've been data dependent. And that's been a big criticism of markets because you're by nature always going to be late. And I think there's a real call now for the Fed to essentially become forward looking. I think that's the big change. In fact, Austin Goolsbee yesterday on CNBC, I don't know if you heard his interview, but he actually used the word forward looking when it comes to responding to financial stability. That is, I kind of would say that's an important word to keep in mind, that markets have been frustrated with a data-dependent Fed. And so I think come September, even if it's 25, but they say that they're going to start being more forward-looking, especially regarding inflation. I think that, they could do 5 cuts this year.
And say that happens, then what do we get?
Well, something to keep in mind is that if the Fed is doing 5 cuts and their dot plot was 3, that's a incrementally dovish Fed. And so I think that is indirectly going to be interpreted by markets as a Fed put back into play, like put for the economy. But now the economy is the stock market and risk assets like crypto. But there's a practical effect. Auto loans, small business loans, which used to use LIBOR, but they don't. They use a SOFR now. Credit card debt, home equity lines of credit, adjustable rate mortgages. ARMs are becoming very popular because of the high cost of fixed rate mortgages. Those will see huge drops if the Fed cuts 1.25 percentage points. So there is a true economic catalyst. I mean, if someone says the Fed cutting doesn't going to make a difference, I mean, this is an economy that's been crippled by high cost, and then you're taking that high cost away. That really would revive demand, at a time when the consumer still has a lot of room to borrow money, actually.
If you enjoyed all of that, then you'll absolutely love the Bankless newsletter. Join over 300,000 fellow readers, all for free. Click below to sign up.